Now, a few things from a Vanderwealth portfolio update. These are common mistakes that we see amongst investors, and one of the things that we expect to be able to help you overcome or with individually. So 3 items. Number 1, trying to time the market. 2, getting caught up or focused on the headlines. And then lastly, number 3, chasing past performance. So allow me to share with you a few details on why I bring this up. These mistakes can not only reduce and cut into your returns and your opportunity for return, but can also create unnecessary anxiety. Allow me to explain. So number 1, investors may be tempted to try and cash out of the stock market or avoid a predicted downturn. This is very difficult to do. Nobody has a crystal ball. And so one thing that we share is that accurately forecasting the market's direction to time when you're going to buy or sell or come in or out is really nothing more than a guessing game. So one thing that we seek to do here at Vanderwealth Management is to use a mix of investments in your account that allow us to stick with the stock market and our allocation within the stock market for a long term. That way we can ride out the ups and the downs. And then secondly, we use and complement that stock portfolio with what we consider to be an income portfolio. And that income portfolio is one that can help level out those returns. It's also money that you can draw on if you're either regularly receiving distributions or taking withdrawals from your account, or if you have an upcoming expense that you may have or incur. So we use our Bander Custom Income Notes. These are a great vehicle and part of that income portfolio. We use real estate, and then especially with the U.S. Treasury and CD rates being as high as they are and our ability to shop them throughout the country, that's part of this income portfolio. This helps us to not get so caught up in trying to time the market, but really ride out some of the ups and downs. And here's what I mean by this. This goes back to 1998, a 25-year period, and it says, hey, $1,000 invested in 1998 would be worth $6,356. That's great over a 25-year period. Now we know that 25-year period has had a lot of ups and downs. If I was trying to time the market, look at the difference in my returns if I would have just missed the best week in the market over that 25-year period. Instead of my total return or my total account balance being $6,356, it would be $5,304. So over $1,000 difference by just missing the best week in the market. If I miss 1 month, you can see the difference. If I were to miss 3 of the best months over that 25-year period, my return from $1,000 would be $4,480 instead of $6,356. And then look, if I would have missed 6 months of the market and been on the sidelines over this 25-year period, you can see how much that affects the total return by mistiming, or in other words, trying to time the market. Staying invested and focused on long-term helps to ensure that you're in position to capture what the market has to offer. So that's why we like to break up the portfolio and say, here's our stock market investments, and we're gonna plan on being in them for a period of time. Yes, they are liquid, but we're not getting into trying to time the market. And then we feel like we have some very good solutions for the income portion of the portfolio, which could also be referred to as the non-stock market investments. Couple of things. The second big mistake is focusing on the headlines. I'm sure we all, as we watch the news and listen to the media, it's easy to allow emotion into the thought process and the decision-making process. This is our goal at Vanderwealth Management, is to help remove some of that emotion. So here's an example. Many of us, we hear and see about the Magnificent Seven: Google, Amazon, Facebook, Microsoft, these companies that get a lot of attention and have real high performance. And that's true, but it's also driven by a lot of media attention. Here's a slide that I thought I would share. This shows companies that before joining the top 10 largest in the US with their annual performance, you can see what it is. And then once they start getting a lot of media attention and hype, look what happened after they joined the 10 largest companies. They failed to outperform the market after previously being in the top 10 for performance. So we don't want to use the media and the news outlets as our source of information. It invokes emotion, and then also it's usually past the point. So that's mistake number 2. Now, mistake number 3 is in chasing past performance. And of course, this is one of the indicators or one of the things that we look at, but it shouldn't be everything. And I just wanted to show this main bullet point that research shows that most funds ranked in the top 25% based on 5-year returns didn't remain in the top 25% in the next 5 years. So the reason I share this is we really want to stick to the fundamentals. We're looking at the balance sheet. We're looking at their earnings per share. We're looking at key economic indicators and business indicators for businesses. But you know what else? Most importantly, we're looking at just general stock market investments. And so here's one last piece that I'm going to share on this. With companies that finished in the top 25% the previous 5 years, you can see what percentage of them remained a top ranked fund the next 5 years. And so you can see it's very difficult to maintain that. That's why we rely less on what we're seeing and hearing in the media and more of what we're seeing just overall with the market. Recap, those 3 common mistakes: trying to time the market. We want to avoid that. Focusing on the headlines, not letting that be our primary driver or source of information, and then chasing past performance. As I mentioned, it's very difficult for companies to maintain that performance. If they were 5 years in the top percentile, it's hard for them to then stay in that top percentile in the next 5 years.